The second one I really like is the medical device space. One, it's kind of inflation proof because when you're at the operating table, you're not going to debate with your doctor how much it costs, right? You want to start a fab for TSMC, you're talking about 10 million to 20 million. It's a big boys game. You're not going to get some startup guy, from a garage in Silicon Valley and say, I'm going to start a fab, right? I'm second guessing Buffett, but yeah, I think for me, from my oil and gas perspective lens, you would want to have a majority of your assets in less politically sensitive areas, where I have to keep fares low. There's no inflationary pressure to the price. I have to keep it low, as low as possible. If not, you're not going to get passive.
Hey John,
right?
glad to have you here today. How are you?
I'm good. How are you?
Yeah, I'm good too. Just having a bit of sore throat.
Thank you for inviting me to your show.
Yeah. Thank you for joining. Yeah, okay. So to start off, right, I saw that you are wearing many hats, serving private mandate clients, being an educator, and also the personal finance expert. Can you give us a brief overview of what you've been working on recently?
So I think I would classify it into three broad areas. The first one, where I spend roughly 60 to 70% of my time, is I help clients with what in Malaysia we call it private mandates or discretionary accounts. In Singapore, is normally known as SMAs, or separately managed accounts. So it's not a pool fund. And those clients fall into two mandates: either a Malaysian only equity mandate or a global mandate. And that's where 85% of my clients are, in terms of the concentration. 8-figure AUM altogether, about close to 50 clients right now. The other 20%, I would say, of my time, I spend training MNCs and GLCs, GLCs, government-linked companies, on entrepreneurship, design thinking, things like that. Because ironically, James, you'd be surprised that a lot of what we do as investors actually overlaps with entrepreneurship. So I find that intersection of business strategy and all that very apt as well, to impart that kind of knowledge. And last but not least, I'm a registered financial planner with the Malaysian Financial Planning Council. Yeah.
Wow, okay. Wow, you really have a lot of things juggling around.
Yeah. But I think it's overlapped most of it lah. So, but key, if I were to summarize the things I do, it's research, look for clients, train with industry. I think in
Very
basic
nice.
sense, yeah.
Okay, so can you take us back to your very first investment, right? What initially sparked your interest in the stock market, and what do you learn from the experience?
Yeah, I think everyone started somewhere, and it would be unsurprising to you that obviously the first investment actually crashed and burned. But maybe I start way back before that. I was a 19-year-old in university, and I was very lucky. A university senior actually gave me the book on Robert Kiyosaki, Rich Dad Poor Dad, and from there, really, it was like the cash flow quadrant, really, when you're an employee and then you're like a solo entrepreneur and then business owner and an investor. I think that really opened up my eyes to the world of investing and leverage, understanding time. As usual, most of us in Malaysia, we started out with unit trust. I'm not too sure about how popular unit trust is in Singapore, but in Malaysia, it's really, really popular. And what I understood after dabbling into it and becoming an agent was that most unit trusts actually tend to hug the index. Very large cap. Very large cap.
Okay.
Yeah, and then it turned out to be, very much a fee sucking instrument. So then, back then you didn't know, but as you grow in
Yeah.
your wisdom and your knowledge and all that kind of thing, then I also did dabble into the properties, real estate investing. At the peak, I owned about 4 at that point. And I
Wow.
found that it was very liquid, one. Leverage can be a double-edged sword. And then once you make a mistake, James, you can't click your problem away. If you buy a property, you can't click it away. So
Yeah.
the joke we have with equities is you click, you can get rid of it.
Gone.
If you make, yeah, it's gone, right? But in property you can't. So the first three stocks that I actually bought, it lost me 25,000 ringgit over 3 days.
Wow.
Yeah,
Over 3 days.
within because I didn't understood it really back then. Now looking back, in Malaysia that time when I was dabbling, it was this thing called a T+3. So now we have a
Oh,
T+1 settlement.
contra.
Yes, exactly. I had a contra. So
Oh,
went into the market, bought 3 times leverage, right? And then contra plus the 3 times leverage because
oh
you
my
are
god.
allowed to buy 3 times more than the cash you have. So
Yeah, correct.
yeah,
Oh my
so
god. That
I
was
think
one painful lesson.
definitely. And
Wow.
my friends joke with me is that I just had my first kid, right? And my friends joke with me is that you gambled your baby milk formula away, is it?
Oh my god.
Yeah. So I bought 3 stocks. Until today, I don't even know what one of it does. It was Ralco, KNM, and Brahim's. Brahim's used to be a airline caterer for Malaysia Airlines, and then I think they just lost the contract or something last year. But you see, all I did was like listen to friends and read some news, and that's it. And I think I wanted to share this story because um, I see that a lot of people are still doing that at the moment. And whenever you hear people, the joke we have today among our invested friends is this: if your cab driver starts talking about it, or if your fishmonger starts talking about it, it's time to get out.
You better get out.
Yeah.
Yeah, correct.
Yeah.
Be
So
fearful when others are greedy.
correct. So no pun intended to the cab driver or to the fishmonger. They may be very good investors, right? But
Yeah.
when everyone the joke is when everyone starts talking about it, it's like it's
Yeah.
time that the euphoria is right at the peak,
Yeah.
right? Yeah.
Correct.
So my real investing really started in 2008, and I was very fortunate that I had a friend who was playing badminton with me every week, and he was a lawyer by training. And my joke with him, his name is Thompson. If he's listening to this, yeah, uh, he has a legal practice. But my joke to him is that his legal practice is funding his real job, which is investing.
Oh, really?
You go to his so he asked me 3 questions. Is that John, do you know Buffett? I said, yeah, I know, and I heard who Warren Buffett is. Have you read his letters? Nope. Then second question he asked is, do you know Lynch? I said, nope. So he's more Mandarin or Chinese educated. So ironically, he read Lynch from Taiwan blogs in
Oh,
2008. Taiwan blogs
2000.
translated lah, because even though he's
Mm.
a lawyer, but he rather read in Mandarin. So he said that it really opened his eyes, especially Lynch. And the next day, I was invited to his office. Outside was all legal conveyancing documents, but when you step into his office, was stacks and stacks of annual reports.
Wow.
2008. Yeah, this is 2008. This is way before YouTube. Just imagine back then, James. There's no such thing as like proper newsletters. It was blog sites, really like blog.
Mm.
No such thing as Substack.
Wow,
Yeah,
power.
yeah. So the old school way, lah, right? Really old school,
Old
hard
school way.
copy annual reports. So
Mm.
yeah, I think because of him, it opened my eyes to this thing called value investing. And
Very.
I got caught the bug lah. I got addicted lah, right? And then
Mm.
one of the first stocks that I practiced this on was this company called DRB Highcom. At that point of time,
Mm.
they own Proton, Honda, yeah, the Hino trucks, okay,
Mm. Mm.
concessions in Malaysia. Bought it on an NTA basis. Entry was about 70 cents, and then we exited about 210, so 3 times our money. So I was like,
Mm.
oh, this is how you make money. It's not the 10-20% go in today in the morning and then afternoon come out. So
Ah,
yeah. So
cool,
it
cool.
it really that was the spark that started the whole thing. Then 2012, I moved to KL. I started attending proper training, proper investing training. But I was just too busy at work. But the real asset test came, James, when it's not just attending class and managing your own money. The real test, I feel, is when you're managing other people's money. And that's when I started managing my family money. That was when the real kicker came in. Yeah, and that's when that was 2014. I started managing my parents' money, my mom, my dad, and that's where you really say, okay, you can't play around now because this is like,
Yeah. This is serious now, getting
this is
serious.
serious. Okay, so over the past 10 years, I started in 2014. So over the past 10 years, my parents' portfolio, my sister's portfolio, my wife's portfolio, my own portfolio. So on average, it was earning between, I just looked back probably last month, KGAP anywhere between 13 to 15%.
Impressive.
Yeah. Yeah.
Yeah.
Yeah.
Beating the market also. Yeah.
Yeah. I
Like,
mean, luck is one. I mean, like, you see the euphoria. No, you see the pessimism during COVID when COVID first started, right? Then I've gone through few rounds of crashes. 2018 was a mini tech crash in Malaysia. So, and then at the same time there were ups and downs during COVID. Or you see euphoria during the peak, and then after that everyone was rushing to glove in Malaysia. So I think that is the real test. You have to go through a few rounds of optimism and then pessimism and then optimism again.
yeah.
Then only you really feel
Boom
like,
and bust.
yeah. And I think I mean, I've been humbled by the market many times, made many mistakes, but I think that was really the start. You run your own portfolio, then you run someone else's portfolio, and then only then going through, like, at least for me at least 10 years of the cycle, then only then you get tested, better ready.
Wow, nice. Okay.
Yeah.
So talking about value investing, right? Just now you mentioned how you read the book and then slowly you got you notice this value investing philosophy lah. So can you share what are some of the key principles that guide your stock selection process?
Sure.
And if you have enjoyed this video thus far, I will greatly appreciate it if you can help me to smash that like button, subscribe to my channel, and ring the bell so you get notified every time I release another stock analysis video.
I mean, great question. I think in the past, I think I would love to. I mirrored a lot of people. The investing legends are Seth Klarman lah, Buffett lah, all that kind of thing. And then you read copious amounts of their work. But over time, one thing I realized, James, is this: you gotta tweak your philosophy to suit yourself, because you can't blindly follow. They were brought up in the US, followed US markets, how the capital markets work there versus what we experience over here in Malaysia. Even though I run a global portfolio now, it also boils down to your own circle of competence, because what you make your makeup, I'm an engineer, and what I make up and my circle of competence and my understanding and how I view the world is different from everyone else, right? And it's very simple that I put it into three. And one of my heroes is this guy called Terry Smith, because I feel his is really very simple, very industrial, very business-like kind of investing. That to me resonated a lot. Yeah, and it's three: buy high quality businesses, pay a reasonable price for them, and either add more over time or do nothing. It's either when you have more resources, add more. If not, then do nothing and just let it go and just ride with it. I used to spend a lot of hours on the financial statements, James, and over time it's changed. Over time, I used to be like 80-90%, financials, then modeling and all that kind of thing. Because engineers, you're very gravitated towards numbers. But over time, what has happened is I now spend probably 20-25% on the numbers, but 75 to 80% on understanding the industry, value chain, the business. And I spend that's a lot of qualitative stuff lah. So in a way, what I do is someone throws to me an idea or an industry or whatever, right? It sparks an idea, right? So I'll spend probably 5 minutes looking through the numbers. Okay, is this worth my time? If it's worth my time, then I start reading the industry, value chain, who makes the fattest margins, all that kind. And that rabbit hole will usually take me easy 2 to 3 weeks, because
Wow,
if it's an industry that I'm not familiar with, for example,
yeah.
medical, like I have Novo Nordisk, right? I'm pretty sure you heard of it. And
Yeah.
I really went into a rabbit hole because I'm not from the medical field. I'm not from the what do you call it, the pharmaceutical, understanding clinical trials or whatever. So everything was alien to me, And when you start like diving, understanding percentages of how many drugs, what's the percentage of drugs making it through clinical phase 1, 2, and 3? What's the composition of semi-glutide, GLP-1? Wow, it's like over your head, but you just keep trying to understand. And the approach of how the company actually creates drugs, it's yeah. So those are the key principles. Buy high quality businesses. Understand what is quality. It's a very simple phrase. Buy high quality business. But what do you mean by high quality? That's where that
Yeah.
rabbit hole really takes up a lot of my time. Reasonable prices, to be honest, it's a I mean, I don't know about you, James, but it's not precise science to me. It's like roughly there. I don't need to be like 0.00 to the PE kind of accuracy or DCF, right? It's like roughly there, if there's bad news, even better, you buy it cheaper. But other than that,
Yeah.
yeah.
Especially in the US stock market. So like, for example, nvidia, the valuation is so high, but when they come out with the results, 700% jump in
Correct.
earnings per share, this kind of thing, you can't really put it into modeling as well. That's how I feel.
Yeah. And the best part is a lot of my clients, they ask, hey John, US market is in the bubble. They hear all these headlines, right? Nvidia is overpriced, all that kind of thing. I said, yeah. So my question back to them was, how many $1 trillion companies can grow revenue by 100% on quarter to quarter? So
That's correct.
yeah. So and the best part is like the best is still yet to come, because I mean, like, if you see what's going on, I'm not sure about what's going on in Singapore, but in Malaysia, people are selling land to data centers like nobody's business. So when there's data centers to be built, right, that means there's a lot of ancillary things. That means NVIDIA GPU is going to be there, networking solutions is going to be there, cooling systems is going to be there. Now the worry for us is utilities, water supply, electrical supply, and all that kind of thing. So I think as investors, you have to put on this lens. I think this lens to say that the moment there is a need, and there's a fervent demand for it, what are the things that you can map out along the way, and I think that's how you should think. I mean, like, for me, what I love to do, and my son has this habit now. We look at labels whenever we go shopping. If I
Same for me.
Yeah, so the moment I find, especially milk, James, there's this milk that's in Malaysia is
Farm
quite
fresh.
popular, Farm Fresh, right? But there's another one called Farmhouse, pink color or green color.
Oh
Pink,
yeah,
right?
pink color. Yeah, I drink
Yeah,
that as well.
yeah. So when you flip, actually the label is actually distributed by FNN, Fraser and Eve,
Yeah,
right?
yeah.
So those are the kind of things that I said. You guys, every time I have like a session to share, a webinar or a seminar to share with some of the potential clients, every time I said, hey John, I just need ideas. I said, ideas is everywhere around you. You just have to look. You just have to you just have to look. I said, even like Kikoman, the Japanese soy sauce.
Yes.
Yeah, it's a listed company. I said, hey guys,
Yeah.
Kikoman, if you really look at it, probably return you 20, 30 times shareholder returns already. So, it's everywhere. It's just how do you change your lens to look at things very differently?
Yeah. Okay, thanks a lot for the sharing. So
Yeah.
now let's dive into some of the industrial stuff. Like, you keep talking about how you like to map out the industries and things like that. So we move into one of your specialties. One being the oil and gas sector, since you have worked in Shell, right, for at least 10 years, building offshore production facilities. So because oil and gas is not within my circle of competence, I always wanted to ask an expert like you, okay, on this question. So because I presume you know that Warren Buffett investments in two oil giants, Chevron and Occidental Petroleum.
Mm.
So based on your own expertise, right, can you shed some light on why these two stocks in particular for Warren Buffett when there are so many oil and gas stocks out there?
Yeah, and interesting observation on their on Buffett's portfolio, and I think before I go into the specifics for these two companies, maybe I just give like a 2 minute or 1 minute like crash course for those who are not from the oil and gas sector. So to give some context, I
Sure.
think boom, straight away, and I start talking about
Yeah,
2P reserves, 2C reserves, then they're like, okay. So I think very simply, oil and gas the industry can be subdivided into three: upstream, or what we normally call exploration and production; midstream, transportation and storage; and downstream, which is the refinery, petrochemical business, part of the business. Now, the unit economics for each will be very different, because the unit economics for upstream, midstream, and downstream, the way the risk is being taken for the business is very different. So what is the risk for E&P? Is actually finding inventory, or what we call reserves. So you think of like, if we're talking about milk just now, right? Your inventory is your cartons of milk, right? Stock. So you manufacture them, but for the E&P, the biggest risk is actually finding reserves. Now, I was very lucky in the early days when I started with Shell. They have this management program that they put you 1 month, James. They will teach you 2 days what is the role of a well engineer, what is the role of a reservoir engineer, what is the role of a petroleum economist. And why I walked away with that, I think the biggest
take away.
insight that I had, your uncertainty is 2 to 300%. Uncertainty
Oh.
is 2 to
Wow.
300%, because you think about, okay, the way I would describe it to a layman, you know, when we drill wells to look for oil or gas, okay, so let's just say your bedroom is what, 100, 200 square feet, one bedroom, master bedroom, okay. So one well, you just imagine a straw, you're poking a straw and finding oil in that one room. That is, if you were to scale it up, I mean, that's how we look at it. You're poking one straw,
One straw.
okay, into the size of your bedroom to make sure
Wow.
it hit that target of a oil well or a gas well. Okay, so,
Oh my God. Yeah.
so the risk is real, right? The risk is real.
Yeah.
That's why people in the US, they call wildcatting, because you're really like wildcatting. If you go and Google this term, wildcatting, right? It's like very rudimentary tools, but then you trying to like hit your payload, right? So when they call a dry well, it's like literally the straw hitting nothing. Yeah, and on average, one well in Malaysia's context is roughly about a shallow well, shallow, non-complicated. It's probably about 10 million US dollars, one well. So if you have an exploration campaign to like, okay, you've done your seismic study, went back, done all the geoscience work, you gotta like put up a proposal to say, okay, how many wells are you gonna drill? And you better make sure it counts, because you think of it as like a map, right? It's like 2D, right? Let's say it's like this, right? This is the size of your now. So you gotta poke. You want to poke in the middle. You want to poke at the side, because you gotta determine how big it is, right? So you don't just poke in the middle. What you normally do is you poke at the sides. You poke at the side, see how big it is, right? And you poke at the sides, then you say, okay, I poke this side, I poke at this side. I said, okay, so it either can be smaller or wider, because you have to think this 2D, then you have to turn it into 3D. Then you want to see, if you poke at the sides, how deep can it go? Where is the bearing of the oil and gas? Because it's layers and layers, it's not like you poke and then there's a hole in there. It's layers and layers of sediments. So at what depth, different depth at different that one. So I tell you, I'm very humbled to have had a chance to understand all this. I mean, Shell paid really good dollars for us to understand, but it actually helped us to be a better professional. Because when we design facilities and we start talking to people, then you're speaking the same lingo. If not, it's like chicken and duck talking, The guy, the well engineer. Yeah. So risk of upstream is finding inventory or finding reserves, okay? And the gestation period from the point you find until the point you produce is anywhere between 5 to 10 years. Okay, long
5 to
gestation.
10 years.
Yeah,
Wow.
and that's fast already.
That's fast. All right.
Yes.
Wow.
Yeah. So I left the industry and I had lunch with some of my ex-colleagues. Some of the fields that we talked about feasibility back then when I was still working, 2016 I left, right? Until today, it's not been explored yet because most likely because of economical reasons. So again, it's not that you find the oil and then you straight away you go and poke the hole. You got to figure out, okay, how big's the reserve? Am I going to spend, if I use this concept, how much money am I going to spend? And then if I spend this much, how fast is my payback period? Is there existing facilities nearby that can tap? Because you could have find the oil is very big, but it's like in the middle of nowhere, right? It's like 500 kilometers offshore. Then you got to think, okay, if I find this oil is very big, does it justify me to build a pipe 500 kilometers all the way to a land station? But on land, do I have an existing facility or do I have to build a new facility? All that comes into play again. So, and then the other thing, if you build that facility, is it next to an off-taker? Is there an off-taker to say that, hey, they can use it for the power grid, or can they use it for downstream manufacturing for fertilizer, all that kind of thing? So the beauty about the oil and gas industry is that if you're well trained, you think big picture. That means geopolitical, 50,000 feet, and then at the same time you gotta think specifics, because every well, like the second project that I was on, I was very lucky. It was a marginal field, production life of 7 years. It took I think 3 years of study to come out with the right concept to make it work. Yeah,
Wow.
yeah,
Just the
yeah.
concept take 3
Just the
years.
concept. You have to debate. Should we put a vessel? Should we put a subsea template? So I do miss that kind of work, because it's really like, it's not just like, okay, we find oil and then let's build a chunk facility there and just go. That's why sometimes you see an FPSO, sometimes you see a shallow water platform, sometimes you see an extension of existing platform. All that is heavily thought through. We go through a process called a decision gate process. So there's 5 gates. Decision gate 1 all the way to 5. 5 is when you actually hand over to the asset, they're operating it, and then you are at a point where you have to determine abandonment. Because the moment there's no more oil, you just don't abandon the facility. You really have to like make good, chop off the facility, decom it, plug the well, all that kind of thing. And you have to park that on your balance sheet. So let's say we're going to discuss Chevron or Occidental, right? Let's say they have 200 or 2,000 producing assets, okay? At the end of life, they have to restore all this back to as normal as possible before they started. And all that is parked under. That's why you see certain oil and gas companies within the region, they are selling for cheap. Because the new operator who comes in, even though it's like cigar butt already, they squeeze the last drop of oil, but there's a cost of abandonment to actually plug back the well and make good, You see? Yeah. A lot of people don't realize that, especially if you're not from the industry. But yeah, that's what it takes. So risk of upstream, finding inventory, risk of midstream is actually capex spend. Because there's a company, it's a spin-off in the US called Kinder Morgan. It used to belong to ExxonMobil. So Exxon used to build all these pipes, to connect all the facilities. They spin it off, and then now it's an MLP. So yeah, so when you spend that kind of capex for pipes, you got to make sure there's an off-taker. You buy you like Dialog in Malaysia, they build like storage tanks. So they make sure that either BP has a commitment, or Trafigura has a commitment, or oil tanking has a commitment before you build, because it's very heavy capex. Okay, that's the risk for midstream. Then downstream, you're always at the mercy of crack spread. So crack spread is really you get crude at a certain price, and that's like if cyclical, right? But at the same time, you're selling your price that you sell, either methanol, ethanol, whatever chemical, RON 95, RON 97, that also has a cyclical price. So the spread is how much you make, the delta in between. And it boils down to two things: your raw material price. So if you have a supplier, like there's a very big plant in Johor near Singapore, actually, the plant actually overlooks Singapore. It's called PREF Camp. So they take a supply from Saudi Aramco, okay, and then they produce it into methanol, ethanol, whatever chemicals, right? And they sell it to the market. You better make sure your plant is efficient. You also better make sure that you have a continuous supply that can feed your plant. So three risks, right? Different risks at different segments of the industry. Now, let's start talking about the Chevron and Occidental investments by Berkshire. So this is not Berkshire's first investment in oil. Actually, the first one was 1956, if I'm not mistaken. Buffett did a presentation on this company called Oil and Gas Management Corporation. Okay, he bought it at around $30 when the crude oil price was roughly 30. And that was the first time he mentioned. No mention on in his letters all the way until 1983.
Wow.
In 1983, so there was a span of about 20 years, 20 odd years, right? In 1983, he made a negative remark on the oil industry. And it was at about $80. It peaked at about, sorry. In 1980s, the crude oil price peaked at about $120. Okay. And at 80, when it was coming down, he made a negative remark in 1983. Okay. No mention again all the way until 2002. And that's when he took a large position in PetroChina. And the crude oil price at that point in time was roughly about $40. Okay. He exited in 2007. So 2002 to 2007, 5 years, right? He exited when the crude oil price was roughly 110. He made a huge chunk of money, right? And then, and because of the cyclical nature of oil and gas, right? I think I really do have to laud Warren. He is quite precise on his timing of crude oil cycles, He's quite, I mean, looking at his purchase of Occidental and Chevron, right? It was a kind of like a historical low over the past like 70 years. So when he took his position, So if you stretch it from 1950 all the way until 2020, right? The points of where he bought his initial position in Occidental in 2020, and then in later part of 2020 when he bought Chevron, it was anywhere between $40 to $20 crude oil price. So so
I saw that lah. I mean, when he actually made the purchases,
it's
so
quite insane.
But the reason, I mean, what I want to know is why particular these two companies? I mean, why not,
why
Shell,
not other Shell or what? Okay.
Yeah.
Very good. Okay. First is the reason. This is my opinion, right? And I share it from my lens of geopolitical risk. Okay, so I'm pretty sure you understand the petrodollar system, James. Do you understand the petrodollar system, where there was an exchange of arms to the Saudi government in exchange for pegging the crude coming out of Saudi? Yeah. So crude mainly are found in very high political risk countries. Actually, one of the largest reserves in the world is this place called Venezuela. So Venezuela has a very big reserve, okay? But now you think of it, you're an operator, okay? You're an Exxon, you're a Chevron or whatever, and you want to go into Venezuela. Now, first of all, do you have the infrastructure? Are you sure that the political regime is not going to change every 2 years? There's a coup, right? There's a overturn. So in Shell, we used to do this evaluation called TCOP: technical, economical, commercial, operational, and political. So it's a risk matrix that we look at, that we say, okay, is it technically feasible? Is it economically feasible? All that kind of thing, right? And P is a very big part, because in Nigeria, where Shell has quite a lot of assets there, People do hot tap on a live pipe, to steal oil and gas. The pipe is producing
Yeah.
gas, and they do a hot tap. They weld it. Can you imagine the risk?
Oh
Yes.
my god.
So I wanted to share this context first, then you understand, then you take a step back. You said, wow, do you really want to operate in that region? Because once you operate in the region, what happens? You've got to hire armed guards to protect your staff. You got to build. So all these are, it is in the link, because political risk then increases your cost of production there. Now, why is this important in understanding the context of buying American oil companies? Is that a lot of the reserves today, not a majority yet, but a lot of the reserves today are more and more being in the US. And the US today is one of the largest producers in the world. It has overtaken Saudi. I mean, because of the shale oil boom, vertical drilling, and all that. In the past, US used to be number 2, number 3, right, producer.
Yeah.
And US never exported. Only more recently then US started, because they had that shale oil boom. They had that. They've never had an LNG facility built over 30 or 40 years, So the one at Sabine Pass was one of the first to be built after 40 or 30 or 40 years. So once you understand that context, then oh, okay, the guys that are producing in the US, it's like, I don't need to spend on extra security. I don't need to spend on, worry about this political risk or whatever. So for me, that was one of the reasons, more and more, that you're getting shale concessions around the US. Yes, Chevron and Occidental still have upstream assets outside, but more and more you start seeing them over time. Even Shell is doing this. They're starting to divest, especially those that are in politically sensitive areas. You see, it's not worth the risk. Yes, I mean, Iraq is still very, very profitable. They still send some of my ex-colleagues there to work on the field. But
Wow.
you think about it, if you're an operator, right, if you're going to commit 20 billion, right, you rather make sure that, 5 years, the political system, the governance, everything is still there, right? If not, right, you start opening up in Venezuela, and then, suddenly a political coup happens, and then, oh my God, 20 billion down the drain.
Yeah. You can
Yeah.
just take over your assets like that.
Correct. Exactly. And that's what happened in Russia. I think BP
Yeah.
had one JV, and then one day
Yeah.
the GM for the operational manager tried to fly back in, and then it says, "Oh, permit denied."
Oh
That's
yeah,
it.
yeah, I read about the news. Wow.
Yes, permit denied, and that's it. They
Oh
can
my
just seize your
god.
asset. You see, so I think that's where I mean, I'm trying to like read into Buffett's investments, because he used to have an investment in TSMC as well. And if you think about that with correlation to this, Taiwan is a hotbed, geopolitical hotbed as well. So it's a risk that he may not be able to quantify. If there's an invasion or that kind of thing. So I'm second guessing Buffett, but yeah, I think for me, from my oil and gas perspective lens, you would want to have a majority of your assets in less politically sensitive areas. Okay, now, in terms of upstream segment for Chevron, they have probably 1/3 of their upstream revenue from the US alone. Okay, in their upstream international has about 13 billion revenue. So out of 17, 1/3 is actually in the US. Okay, downstream, a big chunk of the business is in the US. So that's why it's about 3.94 billion. 4 billion of the downstream business is in the US. Internationally, it's less, like it's about 2.2 billion only. So if I were to look at it, the downstream assets are already like 60% within a safe zone.
US.
Okay. And if you look at Chevron and Occidental's Permian Basin is one of the most prolific shale assets in the US. The Delaware size of the basin they have, right? I mean, it's rather big. And I think, I don't know if you read about the purchase of Exxon on one of the largest shale fields in the US. Long to short, they bought this Shell concession, and the cost of their oil is roughly about $35 per barrel for proven reserves. Yeah, so it in the most expensive. Okay, I don't know if you read about the industry, and different regions produce oil at different costs.
Oh yeah, yeah. The one I know.
You're quite very familiar, right? Okay, so the most expensive
Yeah.
is Canadian tar sands. It's about $50-$60 a barrel to cost, produce
Mm.
to, right? So shale, anywhere between 30 to 40 is actually quite cheap. It's actually quite cheap,
Mm.
right?
Mm.
Obviously, the cheapest is in Saudi Arabia, lah, $9. You poke a hole. The joke is
Oil
you
just
poke a
come out.
straw, you find oil, right? So the other two things I looked at, James, is actually my P2 reserves and also my reserve replenishment ratio. For me, any E&P company, reserve
Mm.
replenishment ratio is actually very key, because if you don't maintain a high reserve replenishment ratio, that means
Mm.
you're depleting your assets so fast that you have no more reserves or inventory to actually produce anymore. So if you look at Chevron's replenishment ratio, their 5 and 10 year is 82 and 99%. That means over the past 10 years, whatever they produce, 99% of it has been replenished.
Wow.
Am I making sense to you? That means whatever they've
Yeah.
taken out from the ground, produced,
Mm.
99% has already been replenished over the past 10 years. So I'm just, again, looking at from an EMP former executive's perspective. This is probably some of the things that Buffett looks at. Because
Mm.
if you're not exploring, you're not taking the risk to find. Remember earlier I mentioned your exploration, the biggest risk is actually to look for reserves, right? If you're not
Mm.
spending that kind of money to replenish your reserves, then over time you will just decay. You will just like, yeah. So, I mean, just to summarize the whole thing, I feel that one, geopolitical risk plays a very big role. Two,
Mm.
your reserves, a big chunk of it, how fast is it reserved? Is it
Mm.
replenished? Sorry. If it's not replenished fast enough, that means the management is not taking the necessary risks to actually, stockpile lah.
Mm. Okay, okay. Wow, thanks a lot for sharing on so much on the oil and gas
Yeah,
sector itself.
yeah.
All right, so now moving on, right? I also understand you're very knowledgeable about the semiconductor fields and the technology trends and all that. So there are a few questions I'm curious as
Mm,
well. So
mm.
number one, out of TSMC, AMD, nvidia, and Intel, right? Who do you think will win in the semiconductor war?
Mm, I think over the short term, it's like people are just piling onto AI lah. But I like to distinguish the different models first lah. I mean, you gave very good names, right?
Mm.
IDM, Intel is an IDM, integrated device manufacturer. The risk is different. The model is different. Unit economics is different. A pure wafer fab guy like TSMC, unit economics is and risk is also different. And a fabless guy, okay. So nvidia, very clear fabless design guy, but for AMD, I'm like on the fence on whether they're really pure fabless, because they still, even though they're spin-off Global Foundries, right? But they
Mm.
still have a very close relation to the former fab that they own at Global Foundries. Okay. So
Mm.
I think for the IDM, the challenge for them is this: they have to win on both design, betting on the right architecture. At the same time, they have to win on manufacturing efficiencies. So you're fighting two fronts, what I'm saying, okay, for an
Mm.
IDM. Okay. Winning one is already very hard. Winning in x86, which Intel has done very well, wonderful, right? But now that's why their manufacturing is lacking, right? And that's
Mm.
why they're starting their fab business, trying to offer their fab, because after learning from TSMC, they say, okay, we're gonna open it up. Now, if you're a Samsung, would you get Intel to fab your latest technology or not? You think about it. I wouldn't. Why am I going to share my secrets to you, right? But
Yeah.
I would give it to a pure fab. That's why TSMC has won, because they only have to fight on one front. I'm not going to fight you on a design. I'm not going to fight you on a brand, right? My job is winning on the manufacturing efficiencies. So I don't care which technological direction you're going. I don't care what architecture direction you're going. They just care of how can I get all my machines to interoperate make sure I manufacture at the most efficient yield. So very clear. The North Star is just manufacturing efficiency. I don't care about design, architecture. It's like,
Yeah.
I don't know, during your days, if you remember DVD, CD, there was the different standards, video standards and all that kind
Yeah.
of thing, right?
Right.
Eventually, at that point of time, you wouldn't know who won, You wouldn't be able to see who was winning, right? And in my years of like understanding the value chain of semicon, I don't like to bet on a brand so much. Because the brand, the closer you are to the consumer, the more likely you'll fail. I mean, I do there are brands from Japan in the past. I used to grow up with Aiwa, Sony. Where are they today? Aiwa, Sanyo, they're gone, right? They're gone,
Yeah.
right? So that kind of like determine your question is who is going to win, right? I rather not bet on brands, but I rather understand the unit economics of each of these players and who is the most resilient of them all. IDM, what's your fight? What's your risk that you're taking? You have to win on design and you have to win on manufacturing. So you're trying to win on two fronts, and then it's a very expensive game on both fronts. Okay, pure fab like TSMC, very clear. I just need to win the manufacturing front, and now they've brought so much technological advancement to the manufacturing. You want to start a fab for TSMC, you're talking about 10 million to 20 million. It's a big boys game lah. You're not gonna get some startup guy, from a garage in Silicon Valley and say I'm gonna start a fab, right? so, so again, so for me, resilience, TSMC definitely there. Okay, then you start talking about the fabless guys, the nvidias and the AMDs, right? Now, what Jensen did to nvidia, he's reaping the fruits today. But 20 years ago, let's try to position ourselves, right? 10, 20 years ago, would you have understood or realized the potential of GPU parallel processing into what it is today? You wouldn't. So for me, right, the game that if you're investor in the game you want to play in semicon is like, don't bet on a design or an architecture, because you never know what will happen. But put on a lens where it says, what is the unit economics for this particular business and how resilient are they to change? I think that would serve you better, because technology wise, right, just change adoption of one standard, you're gone, man. you're gone. Right. And I mean, like, look at HTC. Got bought over by right? Got over by Google, right? All these brands, Motorola, they came out at the Czar at that point in time, huge, right? I used to own a Nokia phone. I used to also own a Sony Ericsson phone, right? All of those, right, are so subject to change that it's very hard to predict, right? But putting on the resilient or longevity kind of lens and understanding how they make money and what are the risks they're taking, I think that for me, that was my aha moment lah in understanding, because I'm an engineer. I always like enamored to technology, wow, this new technology, and then you get so sucked up in the euphoria. But as a business, as an investment, crap, can this guy last 30, 40 years? That is key. That is key, you see. Yes, that is the key question.
Nice. Thanks.
Yeah.
Okay. So the next question I have is that I know a lot of these semicon giants, right? They do a lot of outsourcing to Malaysia semicon industry. So can you share some companies you think will benefit from this?
Okay. Malaysia is very famous for three subsectors. One is what we call the OSAT space, outsourced semiconductor assembly and test. So virtually, when a wafer comes from Taiwan, Japan, or wherever it's coming from, and they cut and then they package it into an IC, Malaysia has a few big players, but definitely not as big as the giants in Taiwan and China. So the leaders in OSAT are like ASC, MCore. In Malaysia, we've got Inari, we've got MPI, we've got Carsem, Unisem. But in terms of size, they are nowhere near the largest. But in terms of margins, actually, Inari has one of the fattest OSAT margins in the world. Just to let you know. In terms of gross and net, they are one of the fattest. My struggle with taking a position in Inari is this: they are very focused on one or two key customers only. So that's the risk that you have to. they have great margins, right? They make great products, but risk is, a very concentrated pool of customers. Okay. Now you talk about MPI, better. They do automotive, power electronics, and all that kind of thing. Is more widely spread. But here's another risk hat lah. Even though they are fatter margins compared to the bigger guys, their scope is being squeezed by front end. So what I mean, in the past, there used to be segregation in the sense that, okay, once I've done with the silicon wafer circuitry and everything, all the packaging is done by the OSAT. But now with new technologies coming in, right, like hybrid bonding and all that kind of thing, you see more and more of the OSAT scope is actually being taken by the front end guys, So there's a question mark for me. Okay. Yeah, Inari has done well over the past 10, 20 years. It nearly became an index stock during COVID. Okay. 11 billion, 12 billion market cap, right? But now I'm like, it's a wait and see to understand how much more are the front end eating into the OSAT for me to understand the risk. I don't know whether I'm making sense to you, James.
Wow, it's too technical for me already.
No, I think
So
yeah, that's why I think that understanding of risk and the industry, it's like you really got to
the
have a
circle of
pulse on it.
competence.
Yeah.
I need to expand my circle of competence first.
No, you're getting there. Don't worry. Then the second largest space is what we call the ATEs, the automated test equipment. So these, obviously, the two best in the world, Avantas and Teradyne, they are right up there, right? Then Singapore, you've got your AEM, right?
Yeah,
Your AEM, right?
which crash.
Yeah.
recently.
In Malaysia, most of our ATEs are quite richly valued. So I don't know if you heard of this guy called Vitrox. They just appeared on
Vitrox,
one
yes.
of Nvidia's. They just appeared the logo on one on Nvidia's Computex presentation. Straight away, vertical up. Right. So, but they are mainly more on the back end because their testers are vision inspection for PCBs and not really more towards OSAT. OSAT, you have another set of ATE players, but they really started off as PCB inspection equipment. Okay, so a little bit more towards the EMS. So that's the third space. So you've got OSATs, you've got the ATEs, and you've got the EMS guys. So the EMS guys, SKP, ATA IMS, and then you've also got the Globetronics. You would argue are either EMS or OSAT, right? So here is the struggle, especially on the EMS side. Net, you're talking about 3 to 5% margins because
That's
EMS is a very labor intensive. It's assembly, right? And I did a presentation once to the OCBC community, the relationship managers. I was like, they wanted to understand the industry. So I actually spent 2 hours like educating them and doing a global benchmarking. So even Hon High Precision, okay, Foxconn, right? Their revenue is actually I think double their market cap or something like that. Because if you think about their net margins for an EMS guy, you're talking about 3 to 5% only. And Foxconn, they are squeezed by Apple because the supply chain. How you make money as an EMS is that you do the procurement. You go and buy the stuff, you mark up a little bit, then only you pass it on and assemble for your client. But Apple is very smart. What they do? Don't worry, I will handle the supply chain. So they will go and squeeze the supplier. They make sure all the components from Samsung, from Skyworks, from Broadcom, and all that is supplied to Foxconn. You supply the labor, okay, and you get squeezed. And if you look at the margins, it's for me. I don't invest in the EMS sector because for me it's very labor intensive. The moment one big contractor just pulls, if Apple pulls or I said Dyson pulls, that's it, man. Your business is gone, right? So there's not much IP there. So for me, it's more the ATE space and the OSAT space that you get a little bit more longevity, a little bit more sustainability in the business. I hope I'm making sense to you. You know, I don't want to go too much into the jargon, but I for me, is the way I think is like, what are the risks to your business, to the industry? How do you hold that moat, if you have any moat at all, right?
Okay.
Yeah.
Okay.
Yeah.
All right. So now let's move on to the next question. High conviction picks. So are there any stocks or sectors that you personally have high conviction in, and what makes you confident in their future performance?
Okay. I like the semicon front end equipment space very much. Because I think the industry has gone through a lot of consolidation over the
Mm,
years. And
mm,
because of that consolidation, right? Ironically, the five guys at the top there, they're not competing anymore, It's more of complementary. You do your sub niche, I do my sub niche. There are some overlaps, but it is so expensive to build something new that
mm.
they stay in their lane, put it this way.
Okay.
They stay in the lane, and it's like, okay lah, you do this reticle, mass reticle, more specifically, okay, that's that one. You are more
And
silicon, silicon ingot provider or specialist chemical provider. You stay in your lane, okay. So what I really like in a way, the consolidation that has happened over the past 10 years has made the stronger the stronger players even stronger. And for me,
mm,
it's come to like almost like an oligopoly that is between one, two, three, four, five players only. So those are the guys that I look out for in terms of high conviction picks. I
mm,
don't give any specific one because all five are for me good. It's just that what valuations are you willing to pay for them? That's all.
mm.
because because like even some guys like who provide the design software, they are selling to you for a PE of about 70, 80 times today. And the cheapest I've seen them go is about 50 times. So are you willing to pay up for that kind of quality of businesses? For me, I'm not yet. I don't have that kind of margin safety to able to do that. Probably when they are 50 times, maybe, right? And they're not growing like nvidia, 100% revenue every year. Yeah. So those. The second one I really like is the medical device space. One, it's kind of inflation proof because when you're at the operating table, you're not going to debate with your doctor how much it costs, right?
Mm.
Right. But if you're buying a phone or you're buying a car, there's always still a choice. But
Mm,
in terms of medical, yeah, you don't have much choice. And again, I like, I learned this from Peter Thiel's book, 0 to 1, right?
mm,
Um, some people argue, wow, it's unfair, competition shouldn't be monopolistic. No, as an investor, I like businesses to be almost monopolistic
yeah.
because
Right.
because then you crowd out the competition, and with higher conviction you'll be able to to make sure that your bet is correct, right? So yeah,
Mm.
yeah.
So when,
I
when
do have
you're talking about medical devices, is it the intuitive surgical?
correct. Yes, yes. And
Okay.
also if you look at Medtronic and all, even though they may not have
Electronic,
high
okay.
margins, but what I like is their breadth of products. Yeah,
Ah,
because if
okay.
you think about it, blood pressure monitor, all that, there's not many players. There's not many
Mm,
players, right? And even though it's lower, even guys like Edward Life Sciences that just does endoscope, right?
mm,
Yeah, it may not have a high replacement cycle whatsoever, but it's quite fat margins, you see.
mm,
And intuitive surgical, it's so funny that it was quite related to my family, what my dad was going through. He had to go through a knee surgery probably
mm.
about 2 years ago. So because of that, I went down the rabbit hole, understanding macro robots, understanding the Rosa robot. So at
Oh,
the same time, I had a chance to sit down and talk to the orthopedic. And I asked him, I actually
mm,
spent one dinner and said, hey, after the surgery, I spent one dinner with him. As an investor, you want to dig more and more from the user itself. What's so
yeah.
captive about the macro robot? What's so captive about the
Oh,
Rosa robot? So yeah. So for me, as I said to you, right, 75 to 80% of my time I try to spend on quality, understanding. This is the Philip Fisher style, the
scatterbutt.
scuttlebutt, yeah, the
Yeah,
scuttlebutt, and you get a
mm,
lot of information from there, James. To be honest, and
yeah.
what you see on the numbers is just a reflection of the quality of the business. So if we're not spending time to understand the quality of the business, then you may not really understand the numbers. That's why I said,
Mm, mm, mm.
yeah, yeah,
Thanks
yeah.
for that. Okay, so next question. Okay, so can you discuss a stock pick that didn't work out as expected, like when your thesis fails, right? What happened and what do you learn about it?
Oh, many times it blew up in my face. Trust me. I mean, like, I think the
Yeah.
best one for me that I use as an example is Asia, because everybody knows that company, right?
Asia.
So if you look back at the numbers 2016, 2017, they were doing very well. I think at one point they had free cash flow of about 2 billion.
Wow.
Yeah, and very simple, because if you think about it, you've got good positive operating cash flow, right? Tourism is high. You just stop taking planes, you got free cash flow already. The business model very simple, right? You
Yeah.
go and buy planes, you take on delivery, you pay, right? Which is capex. But if you look at free cash flow, as long as operating cash flow is positive and you don't spend too much on your capex, you got free cash flow already, right? And the investment thesis back then was that Southeast Asia, island archipelago, people essentially need to fly. They were the lowest cost producer in a way, cost per average seat kilometer, among the lowest in the world, to be honest, right? But actually, COVID really stripped airlines naked, lah. And then I realized, right, the learnings is this, you think about the pricing regime for an airline, right? When I started studying I was from Sarawak, in Kuching, so I had no choice. I had to fly to West Malaysia to attend uni and college. At that point of time, when I was a 17 years old student in 1996, I had to pay 700 ringgit for a flight from Kuching to Alostar, where I was studying. Okay, which is like two flights, Kuching KL, KL to Alostar. 700 ringgit back then. Okay, today, what is the price of airline tickets? Has it gone up or come down?
Come down.
It's come down. So the unit economics doesn't work in your favor, But in medical devices, prices gone up. You see, prices have gone up. So if you think about from a consumer perspective, you're already betting in the wrong horse already, because the prices are coming down, correct, rather
Yeah.
than going up, So for me, it's like, wow, how come I didn't see that? So that was my mistake number one. Okay, mistake number two, how do you keep now knowing that prices will come down? How do you keep costs low to maintain your margins? Right? As an airline, what do you keep? You have to buy new planes, because only newer planes are more fuel efficient, because fuel takes up 50 to 60% of your cost, correct or not? In order for you to maintain your cost per average seat kilometer as low as possible, you have to take on new planes. That means every few years got capex, I said, oh crap, how can I miss that? So second mistake, right? You got to buy new planes, and then planes is not that you order today, tomorrow you get it. It's like you gotta like wait for 5 years,
Yes.
or you pay extra to cut the queue and get your plane, right? That kind of thing, right? So they're always in this perpetual cycle where I have to keep fares low. There's no inflationary pressure to the that one, to the price. I have to keep it low, as low as possible. If not, you're not going to get passengers, right? The second problem is I have to keep investing in new planes, and that means my capex cycle is always high. Okay, now couple the third whammy. Can you control all prices? You can't. So you again at the mercy already, So you know your capex spending is going to be high. You know that there's inflationary, not deflationary pressures on your airfare. At the same time, your biggest cost you have no control over. So I summarize it in this way, lah. There is a joke that
So
says
avoid all airlines.
all airlines. That's it. The unit economics just doesn't work out. Any
Yeah.
airline, Ryanair, whatsoever. Yeah, Southwest has done very well, whatsoever. But you think of all the risk that's piling on to you, right? Which bet you rather take? You rather take the simple bets, right? The ones that has inflationary prices, cost. You can have cost pass-through mechanisms to your client. So for me, I think in that way, it's like, can I pass through that cost? In airlines, I can't. The moment you slap on a surcharge whatsoever, or your clients can go to Scoot, they can go to Silk Air, they can go anywhere, right? Right. There's no captive market, right? There's no loyalty, so to say, right? Frequent flyer, whatsoever. So the joke is this: if you are currently a billionaire and you want to be a billionaire, go and buy an airline. You surely get to your millionaire status, you say.
Thanks.
So
Okay. It's eye-opening to see you talk about AirAsia in that 3 pointers.
Yeah.
Yeah. So okay, next question. Where else do you park your money? I mean, asset. Other than parking it in equities, do you invest in some other instruments?
I'm quite extreme. I would say, apart from my provident fund, which is locked up until I'm 55, I would
Oh,
say almost 90% of my money is in equities. That's I
okay.
used to be a property investor, like I said earlier, for properties.
Mm,
Once I really understood the game, and I'm still learning, by the way, there's still so much to learn. And then when you keep on saying expert, I feel uneasy because I'm like, no, 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 I'm still far, far, far away from being an expert, right? Right. Um, that's my conviction to equities, because one, very liquid. Two, you're betting on not just the horse but also the jockey because there's dynamic management. It's a living, breathing organism. But when you
mm,
buy, for me lah, my lens is when you buy property, it's fixed, it's very cold, right? There's no
mm.
dynamism. It's really a supply and demand. If you're lucky, you bought in a good area and that kind of thing, right? So unless you're buying a REIT, then you've got a REIT manager enhancing it. You've got professional
Mm.
people managing it, enhancing the value. Fighting for
Yeah.
infrastructure to be built. That's different. But if you're buying just like normal real estate property, so yeah, so little
You
bit in
have to be
crypto
your
lah,
own REIT
probably.
manager.
Yeah. Little bit in crypto, but nothing significant lah. Yeah. So
Okay,
yeah,
can. Thanks.
yeah.
So, so when you do all this research, right? I mean, be it qualitative or quantitative, do you have some investing tools that you use?
Yeah. Number one, I still go to Ticker. The guys who found it, one of it is an ex hedge fund guy. The other was a
Yeah.
data scientist for an oil and gas company. So I like the
Oh,
philosophy. I met the founders before.
oh, you
Yeah,
met them before.
yeah, not physically lah. They're based in the
Oh,
states, right? Okay,
okay.
so they do buy data from FactSet. Put it this way, but
Mm, mm,
what I like is the speed of the platform. I've not seen something as fast lah, right? Even if
mm,
I do use Guru Focus as well. I use Market Watch, and all that, right?
mm, mm,
But in terms of speed for 140,000 listed companies, I think Ticker is way up there lah. I used to use
mm,
Share Investor Singapore. They
mm.
also buy data from FactSet. I met some of the managers before because
Yeah.
I'm very, what do you call it? For me, these are my weapons. And I better make sure
Yeah.
like I really understand, is the
How they
data
work.
clean, yeah, or how
Mm,
it works and all that kind of thing. So until today, in terms of price, in terms of that one, Guru Focus, you want detail, I think that's the best. But if you're starting out in investing and you go to Guru Focus, I think it will overwhelm you.
Yeah, I use Guru Focus before, but wow, it's just so much information everywhere, so kind of
Correct,
messy.
correct, correct,
Yeah,
correct. But if you want
and,
the most complete data set with API, Guru Focus is the best. Yeah, because
nice.
40 year, 30, 40-year data, segment breakdown, all that kind of thing. But Ticker for me, I think it ticks all the right boxes. It's just that
Mm,
may not have as much detail as Group Focus. That's all. So for me, it's
mm.
like I happily pay for the subscription, and yeah, it's doing the job for me. It's like I get an idea, pop, it's Ticker. So I probably
Yeah.
log in the Ticker page like at least 10 times a day.
Wow, okay,
Yeah,
your
yeah,
frequent
yeah.
go-to already.
Yeah,
Yeah,
yeah, yeah, yeah. That's right.
okay.
Other tools I
Thanks.
use are like Market Watch, YouTube, all that lah. But yeah,
The main thing is sticker lah.
yeah,
Yeah, okay, sure. So, maybe last question that we have. So
yeah.
what would you give as an advice to your younger self?
I
Or
think
all
prior,
the readers out here lah. Yeah.
yeah, I think prioritization, James. I mean, like, I congratulate you, on taking this and doing this full time. It's not an easy
Thanks.
thing. It's not an easy thing. I've been in your shoes before. One thing that you see in life, sometimes we look back and we say, should have done this, should have done that, right? But
Mm,
everything you do at that point of time, you do with the best information and best decision you can make, right? There's no perfect.
mm,
But I think one thing I'm learning more and more and moving from my present self to the future is prioritization and focus.
mm.
Sometimes you get hung up on like every shiny object. Sometimes you see, oh, it's interesting, then you start chasing. And then this one interesting, you start chasing, right? But then
Mm,
take time to take a step back and then, is it really for me? Are you honest enough with yourself? Because the easiest person to lie to yourself is you. And you say, I'm loving this, or really? Really?
Yeah,
And
really.
sometimes you need help from other people. I used to have a business coach, and I think that really like put honesty back to myself. Do you really, really like what you do? Are you really focused in what you're doing? And the courage, I think more importantly, the courage to lean into the unknown. I think in the business world, to be an entrepreneur, one key skill is being comfortable in uncomfortable situations. Am I making sense?
Wow.
It's just being comfortable just with uncertainty. You just like, what's going to happen next year, the year before, the year after? Am I going to get revenue? Am I going to like be able to feed my family? You just have to be comfortable being uncomfortable. I think that's the key advice that I like to leave the listeners with.
Thanks. I think you're my business coach already. Thanks for the advice.
Most welcome, James. Hey, you take care,
Okay,
James.
so we catch up soon. Thank you.
All right. Bye-bye.
John, bye-bye. Before we end off, if you find the video helpful, I would appreciate it if you can help me to tap the like button and share the video so more people get to know about this video. Next up, don't forget to check out this video over here if you have another few minutes to spare. And I will see you next time. Thanks for watching and ciao.